Assalamu alaikum. Welcome to question 45 of ATX revision kit. This is in your section B. So earlier I've done question 27, which is also uploaded there on my YouTube for my ACCA YouTube members. Whoever are members on my YouTube channel can watch the question. And this is question 45. This is the latest question because it is picked from your March-June 2023 paper. And this focuses on your capital taxes. Capital taxes are your inheritance tax and your CGT. So now we are going to go through the requirements. Today is 1st June 2024. Anya will die on 6th September 2025. So you have to explain the CGT as well as the IHT implications of the gift of some gift of painting on 1st August 2024 for 6 marks. Then in relation to the gift of shares on 1st September 2024, you have to advise on two areas. First one, availability of gift holdover relief and any consequences for CARA of this relief being claimed. Then on the availability of business property relief, when you are calculating IHT, liability on this gift as a result of the death, and any additional conditions for SAR attaching to this relief for 4 marks. Then C, you need to calculate the reduction in post-tax income for the tax year 2024-25 as compared with the previous year on assumption that she gives all of her shares to Kara's plant for 5 marks. So here the professional skill marks will be tested on analysis and evaluation, commercial acumen and skepticism 3. Except communication, others are tested. So now we'll go through the gifts. Now, so he's a tax resident and domicile in UK, never being married, one daughter Cara and two granddaughters, Lava and Violeti. All of them are tax resident and domicile in UK. He made one previous lifetime gift on this date, worth 390,000. Why did they give you this lifetime gift? For you to decide on your nil residence band, whether it is utilizing this or not, and whether it falls within 7 years or not. And it is there within 7 years. Now, what are the proposed gift? 50,000 cash to one of the grandchild and a painting. This is on 1st July. This is on 1st August 2024. If you check the years, both the gifts falls on the same tax year, 24-25. So you have to be very careful when you are doing annual exemption, because annual exemption only once you can claim for that tax year. You can't claim for both the gift. And all of our ordinary shares on 1st September 2024. 3 gifts. Okay, to Kara. Now let us come to the painting. So painting, you have purchased it for 104, but the value is 63. If you see, there is a clear capital loss here. You can see there is a capital loss here. Now coming to the shares, it is an unquoted trading company. We have some assets, land and building, equipment, 2% shareholding. This is held as an investment, inventory and cash. There's a reason why this is given. Remember, the question asked you gift relief, and gift relief sometimes might be restricted if you have accepted assets. And then the income part will read later when we move on to the last part of the requirement, as it is not relevant for our first two requirements. First is only relating to gift of painting, and part B is on shares and part C is the income tax. So the three requirement has been divided into three different sections. So first we'll finish with the painting part. Remember, they asked you two implications, so you have to give two implications. You have to write clearly which tax we are talking about. First is CGT, then is IST. So if it is CGT, there's a capital loss of this much. What happens? Once you talk about the loss, you always have to see who is selling to whom, whether it is connected person or unconnected. This is very important. In this case, it is to a connected person that they are selling because it's a granddaughter. So because it is a connected person, how are you going to get this capital loss relieved? Only against gains made by other deposits to the same person. It has to be the same person, same connected person, because it is a connected person to whom the sale has been made and you have made a capital loss. The only way you can realize this capital loss is when you are making any other gain from this person, same person, in the same tax year or in the future, before she dies, before Anya dies. Anya is the grandmother. Coming to IHT. So CGT is often easier to explain compared to IHT. IHT has a lot of things to explain. So IHT, you are gifting a painting. To whom? To an individual. This is a pet. And when Ananya dies, because Ananya is dying within 7 years, it becomes chargeable. So as there were two gifts, if you see there are three gifts in the same tax year. But the first gift will utilize the annual exempt amount. So will be no annual exemption regarding this painting. This painting was done after the 50,000 cash to flower. So he will utilize this annual exemption. And there will be no nil rate ban also available, because it will be utilized against the gift of investment property on this date. You see here, he made a one previous lifetime gift on this date. This is the earliest, and it falls within 7 years. So that 390, and your nil rate ban is 325,000. So this 390,000, they will entirely use the nil rate ban. So you don't have any nil rate ban remaining to utilize against the painting. And there will be no tapper relief also. Worst case scenario, no tapper relief. Because Ananya is dying within 3 years of the gift. When is the date of the gift? 1st August 2024. When is she dying? 6th September 2025, the next year. The next year itself she's dying, 1 year. So it's less than 3 years. Because it is less than 3 years, no tapper relief also. So now what happens? She will be charged at 40% on this, the value, market value. Market value 63,000. And on that you apply 40%, this will be your IHT, which will be payable by the grandchildren. Now we are moving on to part B, availability of this relief and the consequences for Kara for the relief being claimed. So now, first of all, you have to understand you are gifting a share. Shares are eligible for gift relief. Why? Because it is an unquoted trading company. And also, who is the donee here? Kara. She's a tax resident in UK during the time of the gift. But you always have to see the percentage, how much they are holding when you are gifting a share, the entire share. So because it is Ananya's personal company here, this company is Anya's personal company. She can exercise at least 5% of the voting right. If you see at least 5%, that means it's a personal company. So if it's a personal company, your gift holdover relief will be restricted by the reference to the shares in RQ Limited. And they are investment assets. That's why they're not chargeable business assets. Anything to do with investment will not be chargeable. Only trading assets. You see here. 2% shareholding in RQ Limited has held as investment. This is not eligible, and she have acquired 100%. So that means at least 5% holding she has. It's a personal company where she is having an investment also. That's why it is restricted. They're not chargeable business asset. So the portion of the gain that will be eligible for the gift relief will be restricted. How? It will be calculated like this. Take your chargeable business asset, divide by the value of the total chargeable asset. So your chargeable asset is only land and buildings. Remember, not inventory and cash, not equipment. Land and building, 853. And this is also chargeable but not business chargeable asset. So when you are taking all chargeable assets, you have to add 853 with 60,000. But when you are taking just chargeable business asset, only 853 comes. So from this 853, you take the total, and only this much will qualify for the relief, not the 100%. It is just 93.4% of the gain which will qualify for this relief. Now, what will be the consequences for Kara? See, whenever there is a gift relief, immediately think about the base cost for the donee. Immediately shift your focus to the base cost. Who is gifting Kara? Who is the donee Kara? So when she subsequently disposes of her shares, her base cost, this is the main thing. The main thing is always you have to talk about the base cost. Her base cost will be reduced by the amount of that gift holdover relief. So because her base cost will reduce by the gift holdover relief, when she sells, she's going to have a higher gain. She'll be charged on the higher gain. So what is the impact? The overall is, even though now you're deferring the gain, later on they will catch you. How? By reducing the base cost, you are going to have a higher gain. So anyway, they will charge you, but not now. They are just delaying the payment. Rather than charging now, they are charging it later. But one more thing is here. It's a trick which a lot of students have missed out. That is this one. As the gift will be liable to IHT. Okay, this gift is liable to IHT. That means you have paid IHT regarding this gift on Ananya's death. The gain arising on Kara's future disposal, this have not yet taken place. If Kara wants to sell these shares later on in future, and whatever the gain is arising on Kara, that gain will be reduced by the amount of IHT that was paid. Whatever the IHT you have paid now, you can deduct that time from that gain. This is the catch that many of the candidates have missed out. But remember that deduction you cannot use to create a loss. Let's say you are having 200 gain, but IHT you have paid was 300. You can't deduct 200 from 300 and show 100 loss. But if your gain is 200, and even if you have paid IHT of 300, you can only deduct 200 of IHT from the gain, which will bring down your tax to 0. So the second part is the IHT release. We are talking about the business property relief. So for this you have to know the conditions, and even this will be restricted. So this will be available at 100%. Why? Because it is unquoted trading company, and Ananya has held it for more than 2 years. So these are the two conditions: 100% unquoted trading company and holding it more than 2 years before you are gifting it. So because they have assets that falls under investment, that means it falls in the definition of accepted asset. So the relief will be restricted. So it's the same. You take the entire value. You take this 1034, and from there Only land and building is business assets, and 60,000 is not, is the accepted asset. So you take the 60,000 out from there and divide it by this 94.2%. They are not the same as the CGT relief, the gift relief. This is different. Okay. And Kara, for Kara, she must still hold the shares or the replacement business property when Anna is dying. Otherwise, BPR will not be available. And your shares must still be business property at that time. Now the C, this is easier for the 2 years you have to take. So you have been given some income here. Gross annual taxable pension income of 65,000. Only source of income has been dividends. Chesky paid a dividend of 40,000 on 14th Jan 2024 and pay a dividend of 34,000 on 30th Jan 2025. So what should you do? See, they told it's annual pension. Okay, annually you are getting the same pension, 65. So both the years it will be 65,000 and 65,000. Then dividend of 40,000. You take in 23, 24. Here you don't take the dividend. Why? Because you have not yet received it. They will pay a dividend. They told they will pay a dividend. Please check the form. Here they told they will pay a dividend. It has not yet been paid, but here they have paid the dividend. They have received the dividend. Okay. So now only the dividend that you have received you can write. Dividends that are payable you can't write it as income. Then you get a total income and personal allowance. There's a working. This there is no problem because it's less than 100,000. So you take the full personal allowance. But here if you see your total income exceeds 100,000. So you have to restrict your personal allowance. We'll go to working one. So it is 105 minus 100 divided by 2 and from this you minus. So this is your personal allowance now. 10,070. So you take it here, get your taxable income. Once you get your taxable income, you see this higher rate. This is also at higher rate, taxpayer. So the basic rate at 20% and the balance will be at 40% for both. But because there is a dividend here, 40,000, remember there is a dividend nil rate band and it is available irrespective of your taxable income. It's always there. So 40 minus 1 and dividend falls at a higher rate. So at this rate, 33.75. But your pension income, once you deduct personal allowance from your pension income, will fall in your non-savings rate, 20 and 40. And it's only for this year. So you get your total tax liability. Once you get your total tax liability, this is not what the examiner asked you. You still have one more step to go ahead. They asked you the post-tax income. That means from your income you have to deduct the tax. So what is your total income? 105 and 65. So from 105 and 65 deduct the tax of the two tax years and this is your post-tax income. If you missed out on this, you are going to lose away 1 or 2 marks. So you should not stop here. You should rather stop here. That's why I always read the requirements very well to know that where you have to stop. Even this is not the final step. The final step is this one. They asked you once again, I'll take you back to the requirement. Reduction in their post-tax income. How much post-tax income have reduced in this tax year compared to previous? That means you have to compare the two things. So 2024 it was this. Now it have reduced from 77,405 to 51,568. So the difference is your reduction. Your income post income tax is reduced. This is what the requirement asked you, and for this you get to get 1 mark. Even if it's a 1 mark, it's no joke, because sometimes students, most of the time, they often fail because of this 1 mark. They're failing at 49. So you should not take it as a risk. Okay, this is what. And after you do everything, then only you have to show your working. Do not show your working inside your main requirements. After you finish the entire requirement, let's say this is relevant for requirement C. So finish all the parts of requirements and then show your working one. Okay. So that's it for this question. We have finished it. You can go back your revision kit book and read the examiner's comment on that. Since this is the latest paper, make sure that you do it. And also you can go to the marking scheme. So I shall see you in the next question, again which will be from section B of your ATX.